we'll kick off trading hour with some market opinion coming in. Sumit Jain from Ask Investment Managers is joining in now to discuss market fundamentals and his top sectoral bets as well. Sumit, good morning. Thanks a lot for joining in. To start off with possibly the sector of the day, that is IT, because management commentary has not changed whatsoever from where it was at the end of the previous quarter. And right now, with the hope coming in from the Fed that, okay, there will be rate cuts maybe in the second half of the year and more rate cuts in 2025. But demand, at least discretionary demand, has not picked up whatsoever. Do you believe that, okay, let's wait it out, let's bet on this sector, wait it out for a quarter or two, and once the cycle turns, it'll start to pay off?
Thank you, Armas. Thank you for having me here. So, see, in case of IT especially, things have not turned out the way most of the managements have anticipated. Clearly, growth rates for some time, as you rightly said, have disappointed. But these businesses keep responding to how things play out globally. Not only with respect to global macros, how GDP growth rates there play out, but also with respect to how interest rates are expected to behave. But these are, I would say, more shorter term behavior. We really believe that those businesses which characteristically can't grow at a pretty decent pace for a significantly longer period of time actually would be more of trade rather than more of compounding opportunities. So in this case, in specific, we would like to believe that even if we see a bounce for some time because of these factors, we would think that there are better opportunities to play in markets rather than being focused on businesses which possibly should grow even if things kind of normalize. Um, Probably at about low single digit, rather high single digit or low double digit. In the short term, we still don't anticipate growth rates to be of the number that I'm talking about. In fact, this year is going to be a year where growth rates possibly should be mid-single digit. This year, for most of these businesses, margin maintenance, or possibly improvement in margins, that will be a priority rather than focusing as much on growth. They are continuing to see leakages on business, right? So we still need to watch out for as to how trends shape up for these businesses before we kind of take a longer term call. But having said that, we would rather like to believe that there are some businesses within this pack which are more specialized, uh, something like ER&D or those kind of businesses where growth rates possibly can be of a number which is significantly higher for a length of time because trades or rather businesses are um, possibly being benefiting out of the long-term trends that are playing out. So that's the area where we would focus on rather than focusing on businesses which are really run the business kind of scenario rather than change the business.
Okay, that's an outlook on IT. Sumit, overall, I mean, I was going through your note, and I think you're expecting a slightly more modest FY25 in terms of overall, market returns compared to what we've seen in the past. So just give us the portfolio construct right now. You still seem to be quite optimistic on Capex as a theme. So just tell us, biggest overweights, number two, number three.
Sure. Thank you, Subi. So see, fundamentally, are more positive on domestic story as compared to more kind of businesses which are rather internationally driven or globally linked. So to that extent, if you look at our portfolios, they would be more focused on how things play out on the domestic macro front. So we actually are very positive on, we continue to remain rather very positive on investment related businesses because now we are seeing this continuity, the confidence there has increased further, at least for some more time. So to that extent, there is an expectation that we would see significantly higher acceleration in many of these areas, which are, let's say, defense, railways, green energy, energy transition. Many of these areas should see continued growth or rather acceleration of growth. Second area where we believe growth rates will accelerate and have not been the case for some time though, is more related to small ticket consumer discretionary. We really believe that rural distress, which has been happening at the current point in time, has had impact on growth rates of many of these businesses. And with, I mean, IMD also kind of predicting that La Nina conditions should prevail this year, should mean that rainfall should be either normal or above normal. And with focus on bottom of pyramid as well, we should start to see rural recovery, which actually has been a problem area. So quite a few businesses there with respect to consumer discretionary, even autos, those should start to do well. While auto on the two-wheeler side, especially, things have been all right. And we really believe that that is one area where we should see continued growth.
Sumit, you spoke about sectors that will do well. Let me ask you about a sector that you believe is facing some challenges, and that is specialty chemicals. The entire sector has been a massive underperformer over the last 12 to 18 months. And you also believe that there are still pricing challenges that persist when it comes to China and other uncertainties as well. Now, you have reduced your exposure to this sector in the recent past, but do you believe that there is a cycle turn coming anytime soon? And if that happens, would you want to have a relook at this sector?
So it's not that we have reduced our exposure now, we have been reducing it for a while. Our view on specialty chemical is, and see, if you look at the impact on these businesses, they have actually got impacted because of significant destocking that many of, or rather this industry was witnessing. Also, China came in a big way. So there was huge supply that came up. At the current juncture, possibly destocking effect should be behind. Many of the management are now talking of at least normalized volume numbers, but pricing remains a concern. So we will have to clearly watch out for as to how pricing really plays out, because if pricing doesn't play out, possibly ROC of these businesses would be lower than what they used to be in the past. And that would mean that value creation possibly would be kind of lower as compared to what we have seen in the past. So to that extent, pricing behavior remains a key monitorable there for us to really take a call there.
Okay. Where do you stand on financials, Sumit? And do you have a view on life insurers? I mean, do they make it to your portfolios?
So we have limited exposure towards life insurance businesses in general. Coming to the financials, we believe that banks per se will continue to face some challenges. While credit growth should remain buoyant, pressure on NIMs should continue, at least more so for banks, because deposit growth remains a challenge. Having said that, NBFCs is one area where we are seeing growth rates continuing, and there is a high chance that if interest rates go down, we may start to see margin expansion as well. And those NBFCs which actually understand their customer really well, who can control their gross NPA, and they can kind of show a decent growth and yet report a decent ROE. I think those are NBFCs where we would like to focus more on within financials as compared to banks.
Interesting, Sumit. Thanks a lot for joining in and sharing your opinions on the markets and specific sectors as well. Some more visuals coming in from